Everybody, Jim Barrett from RJO Futures. It is Monday, August 3rd. Bonds on a tear again today. This morning up almost a point briefly, which makes it almost 10 points in 3 weeks. 10 points in 3 weeks, huge. Yields have fallen from 3.25 down to 2.84, and the 10 years yields have fallen from 2.46 down to 2.14. How did all this happen? Well, news flow basically, and a waffling stock market and a failed upside breakout in the NASDAQ, to name a few. Actually, the wage flop is maybe the biggest thing. Last Thursday, Friday, I can't remember, we got a big push into bonds, even higher, even to lower yields on a meager 0.02 in the second quarter employment cost indexes. Very disappointing wage growth, very disappointing for wage earners, keeps the economy subdued, keeps consumption subdued. These are the lowest wage increases on record. All right, so that's number one. Number two, the general commodity collapse, especially glut in crude oil, the world's most important commodity, and also in a commodity that's representative of the class, gold, new lows, new 4-year lows. There is no inflation. There really is no justification for the Fed to embark on a rate rise cycle, and the bonds sense this, and people have been locking up yields here, not afraid of what the Fed's going to do. Whether they move in September or December, not such a huge deal, because there's not room to move a lot given economic reality out there. All right, the third reason probably we've had this 2.5, 3 week rally in the notes and bonds is, again, the waffling stock market. The S&P refuses to do anything. It does manage, or has managed up to this point to come off lows, but then the rallies definitely get nowhere. And here we are under pressure again today, led by Apple, down 2.5%. When one of the darlings that is an all-free index goes down, the stock averages or the stock indexes are going to look bad, and it's going to hurt sentiment a bit and give people all the more reasons to chase this rally in bonds. How much farther can we go in notes and bonds? It's always probably the wrong question. I mean, it's going to go as far as it can go. I mean, at this point in time, there's no sign of a reversal. The trade location is a little dicey. We've met some objectives. It's likely the ascent in the bonds is likely to slow, as again yields are down significantly from 3 weeks ago. Reports later in the week. Later today, we find out how much the Treasury is going to need for their quarterly refinancing. Today we already got a weak economic number, go figure. Tomorrow we have ISM manufacturing, probably going to weak also because the oil patch is just being crushed. Construction spending, here things are a little better, there's a little growth. Auto sales, again, here's kind of a brighter spot in the economy. End of the week, the big deal will be a jobs report. They're looking for 2.25 right now. They're looking for unchanged 5.3%. So we'll see. Friday, obviously, if the job growth remains underneath 2.25, I mean, this rally will probably hold. It would take, significantly higher than expected money, number Friday to really derail the upside in the long end. I can reach at 800-500-2461 to discuss any futures market. Give me a ring. Thank you. On futures may involve substantial risk and may not be suitable for all investors.